Now we'll look at actually how to calculate the break-even point in the sales at target after-tax income. So cost behavior, you have fixed cost. These remain unchanged when levels of production change. Variable cost, these change in proportion to changes in volume of activity. And then you have mixed costs that include a little bit of both. Just remember, fixed plus variable equals total cost. Now for CVP analysis, I want you to think all costs are either fixed or variable. Don't think of any other categories. So break-even point in units, break-even point in dollars, dollar sales, and unit sales at target after-tax net income and the margin of safety are what we're going to look at. So first, what is contribution margin? You have to know this first. Sales minus variable cost is contribution margin, minus fixed cost. That gives you net income or loss. What is unit contribution margin? How do I get there? What is it? It's the point where unit selling price exceeds total variable cost. And the sales dollars that remain after covering variable cost to cover all fixed costs and any profit. That's actually the definition of contribution margin. How many sales dollars do you have left after you've covered the variable to cover any fixed costs and any profit? Contribution margin per unit. How do you calculate it? Sales price per unit minus variable cost per unit. And then how do you get the contribution margin ratio? You take that contribution margin per unit and divide it by sales price per unit. It's used to calculate break-even in units. So you need the contribution margin ratio to figure out the break-even in dollars. So let's compare this to an equation you may remember from financial accounting. Sales minus cost of sales, or cost of goods sold, is gross profit or gross margin. Contribution margin ratio, we're looking at sales minus variable cost, gives you contribution margin. But this is not the ratio. It's one more step. You take gross margin, divide it by sales, and it's expressed as a percentage. Contribution margin, take that, divide that by sales, and it's expressed as a percentage, the ratio. So why do we need this? It's to calculate break-even. How do you do it? Fixed cost divided by that contribution margin per unit, and with this example, sales price 125, variable cost per unit 95. Fixed cost, though, we're talking about total. We're not talking about unit because it's fixed. So my contribution margin per unit is 30. 24,000 fixed cost divided by 30. I have to sell 800 just to break even. Once I sell 801, then I start making profit. So that's in units. Break-even point in dollars, you simply take the fixed cost. Instead of the contribution margin per unit, you divide it by the contribution margin ratio. Same example. I take the contribution margin per unit of 30 divided by 125 to give me that ratio of 24%. Then I take the fixed cost, 24,000, divided by that ratio. So that means to break even, I have to sell $100,000 worth, have that much of sales. Now double check your numbers, take the original units, multiply it by the sales price, and it gives you the break-even in dollars. So the key to remember, contribution margin per unit gives you the break-even in units, the ratio gives you the break-even in dollars. So think unit for units, ratio for dollars. And the sales at target after-tax income, how do we calculate this? So instead of breaking even, we want to see how many do I need to sell to actually make some money. And we calculate that the same way, only we're adding a little number, that target pre-tax income that I want to make. Because contribution margin is how much is left after covering variable costs to cover my fixed costs and any profit. So I take fixed plus my target income I want to make, divide that by the contribution margin per unit, and if I want to solve for dollars, contribution margin ratio. So let's look at an example. My after-tax net income $750,000, but that's after, not pre, and I need to get to pre. The tax rate is 40, sales price $125, variable $90, fixed cost $625,000. Okay, so first we have to get to pre-tax. So if I'm $750,000 is my after-tax, I divide it by the 60%, because if my tax rate is 40%, then the IRS gets 40%, I get to keep 60%. So when you see 1 minus the tax rate, that's what that means. And you can double check your number. If you pre-tax is $1.25 million, you get to keep 60%. Do the math, and if it equals that after tax, you know you did this correctly. Unit sales at target after tax net income. Let's look at an example. So we have $625,000 fixed cost plus the pre-tax income divided by the unit. That means I have to sell 53,572 units to get that after-tax income. So let's take that number, 53,572 times the sales price. That means I need to have a revenue of that $6,696,500 in order to get to where I want to be after taxes. Now let's look at variable costs. We're just going to look at this a different way with a contribution margin income statement with the real numbers. So if I sell that much to cover my per 90 variable cost, sales total minus variable cost total gives me a total contribution margin. What are my fixed costs? There's my pre-tax income. And the ratio, let's look at this one. I'm going to divide it by the 28%, and the numbers came out the same.